Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Now, folks, it's not only the conversation of the day. I think it's sort of the conversation of the week. It's a holiday-lengthened work week. It's sort of weird. And then there's after. Lori Calvasina joins us, head of U.S. equity strategy, RBC. She says, to play, to win, you have to participate. What do markets do after Thanksgiving? We used to shut down November 15th. We got an M&A boom. Wall Street's mental. What do you foresee to the end of the year in terms of oomph?
So it's a great question, Tom. And I think as we are sitting here this morning, the futures are up a little bit. We had a good Friday. We had a very
John
strange...
Williams had a good Friday.
He did. And look, I mean, anecdotally, it sounds like there are a fair number of people who wanted to take some time off this week that aren't getting it. So I think people are, at a minimum, are going to be cranky when they get back after December. But I think the reality is that there have been a lot of things causing stress in this market. Maybe not any single one of them enormous stress, but it all kind of adds up. I think the Fed was one of those, frankly, because we had seen expectations for cuts taken out. And when you've seen that happen in recent years, kind of going back to late 2022, that tends to trip up the stock market. And when we put cuts back in, it tends to help the stock market. So I have no idea what they're going to say. I know that RBC's rate strategist has been in the December skip camp, and then he thinks they resume next year. So my guess is the drama is not yet over. But we also know that valuations have been a problem since August, and we've seen, FY2 valuations sort of bumping up against ceilings. We're going to cycle into new earnings at some point, but right now, companies don't want to talk a whole lot about 2026. So I think I
don't think they want to talk about December.
I don't think so either. I mean, I will say, the consumer companies are coming up. We've got a few more this week. They're kind of trickling in. It was kind of hit or miss last week. There were some good ones. There were some not so good ones. It does seem like there are certain retailers who are winning with all cohorts of consumers that have more value conscious offerings. So I think companies are still managing through pretty well, but this feels very unsettled, to be honest, coming back post-Thanksgiving.
So I know you guys at RBC have your 2026 outlook here. What are the themes that you're going to be focusing on for 2026?
So, we did sort of an early cut back in September of, this is what we're seeing for the second half, kind of a second half September type target. We haven't done, sort of here's the big burrito for, the one that everyone writes at the end of the year, partially because we had done that early one. But we had been saying 7,100 for sort of a mid to second half 2026 kind of number. And I would say our messaging hasn't changed, which was that we have thought for quite some time the market was way overdue for kind of a 5 to 10% garden variety type pullback. We finally crossed the 5% threshold on Thursday. That's very good news, because I'd rather get this out of the way now than have it overhanging the market early next year. And the way we've put it is we think stocks can do well next year, but we do think we have some stuff to work through to get there. And the good news is we finally started working through those things.
But we've got arguably strong earnings environment. Second and third quarter earnings were very, very good. We've got presumably a Fed that's in a easing mode. Are those two things in and of themselves enough to move the market higher?
This is the interesting sort of part of the Fed conversation from an equity market perspective, right? Which is, 2 or 3 more cuts, right? Mm-hmm. I mean, that's good and that's helpful, but it's not like we're at the beginning of something big and long lasting if you look at most forecasts around the street, right? This is kind of a modest adjustment cutting, type cycle that most folks are talking about. I do think earnings growth is extremely important. I think that's what's been powering markets.
Can you model it out for Q1 2026?
In the first quarter, I think that I think January is going to be sort of a pivotal time, to be honest, Tom, when companies really kind of unveil the 2026 outlooks. And we keep seeing that in commentary, right? Analysts who dare to ask the question are getting brushed back, and companies are saying, we'll get back to you in January or February. I don't think anyone's really going to care, honestly, about 4Q results by the time January, February rolls around.
Interesting. Lori Calvasina, we continue with her with RBC Capital Markets. I went nerd early in the show. I'm going to do it again with the lawyer, Paul. Can we go back to memories? John Malone, Tacoma. Remember TCOMA?
Yeah, darn right.
Okay, there was an invention, believe it or not, in the 60s, this didn't exist. Enterprise value to EBITDA. This weekend, I saw essays of this ratio of debt cash stock as compared to the income statement, somewhere in the income statement plus depreciation, amortization. Do you have a conviction that in the cacophony we're living now, you can use a modern ratio like EV to EBITDA?
So, it's funny, Tom, a number of years back, I actually surveyed all of my analysts about what valuation metrics they thought were appropriate for their industries. And I made them give me two. And I did find that a lot of the tech-related analysts gave me EV-related metrics. That was really where it tended to be limited, to be honest. And then the thing that everybody sort of agreed on, it may not have been their first indicator. In fact, it usually wasn't their first indicator, but forward PE. Yep. So I tend to still be a forward PE person because I think, when you're comparing industries, you're comparing sectors, you're comparing size segments, you need something that's more universally applicable.
All right, let's stay with the earnings theme here. Are the earnings strong enough to support this market and to drive it higher right now, do you think?
So, there's healthy earnings growth embedded in the consensus expectations for next year. When we've modeled it out, we haven't gotten quite as constructive as consensus, but we've still got, some healthy numbers, I think around like 10% or so. The reality, though, is that earnings sentiment matters just as much as the earnings themselves, and the rate of upward revisions for the broader market peaked in August. We don't have post-NVIDIA, sort of results yet. For that particular indicator that we look at, the rate of upward revision. So what I need to see in coming weeks is as analysts go back and do like all their little modeling,
right,
and update all their numbers, do we surpass or return to that August peak? And we just don't know the answer to the question yet. But I think one thing markets are struggling with is the idea that earnings sentiment, it's okay, it's just not as good as it was.
Interesting. Lori, we don't care. What we care about is how do you do mashed potatoes Thanksgiving
I'm going to
morning?
be honest with you, Tom. I don't cook. I hate cooking. I burn everything.
God, I married the wrong woman.
We with our Thanksgiving, we go to my in-laws and we're responsible for mulled wine, pies, and bread. And we buy some very nice pies.
How do you make mulled wine? You like cooking Wednesday night?
I'm going to be honest. I don't do this either. I run after the children and let my husband do it.
Okay.
See? Honest, right in front.
I think that's actually a lot like Lisa
Full
Mateo.
disclosure. Yeah.
Lori Calvasina, have a wonderful holiday. Thank you for that brief, and particularly the CFA worthiness of EV to EBIT. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us on Smartest Man on the Planet, Michael McGlone, Bloomberg Intelligence Senior Commodity Analyst. Tom, stop making fun of Bitcoin at 30,000. Boom, up it went. Gold, boom, up it went. What are you focused on, oh wise one, this morning?
Well, I want to tilt over to your term before, Tom, of bit dog. I think it's becoming bit dog. The world's changed for cryptocurrencies. We had this massive pump on the halving and the ETF pilot and the Trump administration jumping on board and very well entrenched in the space now. And it's peaked. It's classic, I think, peak, bull market peaks on euphoria. The thing is now it's dragging everything lower with it. So as of Friday, the Bloomberg Galaxy Crypto Index was down 21% on the year, was up almost a third. Bitcoin is right now down about 10% here, and the key thing is where's it go next? And the key thing I look at is at the same time cryptos are going lower, stock market volatility is just buried. Now we know the VIX is up, but 120-day volatility is still around 11%. That's a very low level. So I think the whole space has got more de-risking to go into the end of the year, which is probably the primary risk.
Is there, for Bitcoin, does technical analysis work, Mike? And if so, is there a support number? Like, I don't know. I just kind of thought support was 100,000 and we blew past that.
Exactly. That was the key level, certainly psychological. Now, Paul, it has to work. It doesn't necessarily it has to work, but it has to matter because, as Tom always points out, there's no underlying. There's no basis. Like I trade crude oil futures. I know I'm trading those against crude oil. I trade treasury bond futures. I know I'm trading those against treasury bonds. In Bitcoin and cryptos, there's no basis except for crypto dollars. So the key level now, I think, is around 84. It's been holding 84. It's a decent support level. The key resistance is around 94. That'd be unchanged on the year. And my bias, it's it's more at greater risk of breaking through 84 and getting towards 50 than going higher. And the key thing about 50 is I love how crypto people say, look at the chart, but if you look like an annual chart going back to 2020, 21, 50 has been a key level for many years.
Wow, 50. All right. Gold seems to be holding at that 4,000 level here pretty solidly, Mike. Is that a good support here?
It's becoming a part of it. Gold's been a stair-step rally. Step up to 3,000, hang out. Step out to 4,000, hang out. The problem is now it's so extended versus a 60-month moving average. Tom would like this. It's about a 3 standard deviation move. You have to go back to 1980s. And the key thing that's happening about gold, it's never rallied at this type of velocity with stock market 120-day volatility this low. That's just never happened. That's what I'm concerned that volatility might pick up into the year end.
Mike, we don't care. Coral Gables, Florida. Is the real estate market cracked? I mean, real estate never goes down in Coral Gables, right?
Well, I'm hearing it everywhere, Paul, certainly here. Recently reduced. Most buyers, most transactions now are reduced prices. And that's what I get from my colleague on the journalist team, which I sit right next to. I'm hearing it everywhere. Same with farmland in the Midwest, which I'm very close to. Recent reduced prices are all trying to drop. They're just not lifting offers anymore.
1.6 million, Navarre Avenue. Cozy, 2,000 square feet.
Oh,
it's a cozy house. It's cozy, 33134.
All right. I mean, but Mike's living in some high-rise Miami thing with all the highfalutin folks.
Then you got to play Miami Vice music.
Exactly. He's not doing the bungalow thing.
I mean, okay, I may have to do a road trip down there.
Yeah.
Span the.
Mike will take care of us.
Michael will
show us around town.
Tour. Put me on the Harley and off we go. Michael McGlone, thank you so much. Have a wonderful beginning to the holiday season. McGlone, smarter than the average bear.
But all the people are swarming down to South Florida, all the snow bunnies, and so Mike can't get a reservation in his restaurants anymore.
And they're talking like New York City people, a new wave going down. Yeah, maybe.
So all the people coming down for the winter time.
I don't know.
Can't get a parking spot anymore.
Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
She has been more than patient. RaeAnn Mitrione is at Callan Family Office, scheduled to be with us a few days ago, and there was this breaking news or that breaking news, and we had to say, see ya. Right now, we celebrate RaeAnn Mitrione with us. Do you have a clear vision, RaeAnn, for Callan Family Office into next year?
Yeah, we're relatively optimistic. There's a lot to feel good about. I mean, earnings have been incredibly strong. We're just wrapping up the 4th straight quarter of double-digit earnings growth. Spending has been strong, especially obviously as related to AI, and that has been providing a huge tailwind to stocks. And we have a generally dovish Fed. So all of that helps us to think that we should still continue to see some upside possibility for equities going into next year.
How does tech lead?
Tech has been incredibly strong, right, over the last couple years. And we've seen this since the April lows. And now we're getting a little bit of volatility, which is healthy. But there continues to be a lot of strength in that sector. I mean, we see these hyperscalers that are spending these incredible amounts of CapEx to build out their AI infrastructure that's going to have huge demand. And really, that's such a big part of the market that as long as those companies continue to do well and we see that demand hold up, it should continue to help the tech sector.
I just said Lori Calvasina was the interview of the day. I'm sorry, RaeAnn's killing it, Paul.
I know.
Because this is a tone I hear from people. Her in the trenches, her belief on conviction in the market is a lot of what I hear out there from people.
Well, she's a graduate of Vanderbilt, so she's riding high along with Damian Sassower and the football team at Vanderbilt. But technology, RaeAnn, I'm just looking at your notes, and you laid out so clearly. NVIDIA is 8% of the S&P 500, and mega cap tech is almost 40% of the index. So if you're constructive on the market, you got to be constructive on tech. Is that kind of where you guys are?
You really do. I mean, because if those companies are struggling, the broader market is going to struggle. Now, that being said, we do want to have diversified exposure, and we want to have, investments in other areas as well, because these can move the market so quickly, as we've certainly seen. But you have to have the exposure, or you've been missing out.
How else do we think about these equity markets here, RaeAnn, outside of technology? Are there sectors that screen well for you? Are there factors that screen well for you?
I mean, we want to have exposure broadly. We've certainly seen tech do well. We've certainly seen utilities and industrials do well in their ties to all this data center spending. We want to have exposure to financials is another area. But I mean, we want to have exposure on the value side of things. We want to have small cap exposure, and we want to have international exposure. I mean, international has really outperformed U.S. so far this year, mostly due to a weaker dollar. But we do want to have exposure in all those areas.
RaeAnn Mitrione with us. She's partner at Callan Family Office. I'm curious into with all the success of this bull market, at a family office, do you have a pressure to over diversify, or is it under diversification with more focus, more bet on a given idea?
It really depends. We have the ability, because we're working with ultra high net worth investors that really have a multi-generational focus. So we can be more aggressive. We can take some of those bets, because these clients don't necessarily need those funds near term because of the level of wealth that they have. But we do tend to diversify, and we have the ability to get into parts of the market that some traditional investors may not be able to get into when you're looking at private markets and hedge funds and different types of things that allow us to complement our traditional portfolios. So that's been, something that we can do, but I wouldn't say that there's pressure, but there's certainly a lot of opportunity, and we do believe in diversification. I
mean, Paul chastised me because I haven't brought this up today. Have you bought in to public or private credit?
Ooh,
I mean, alternative investments, or do you guys stay a mile wide of that?
No, we certainly have exposure there. I mean, we do have traditional bond allocations. A lot of our investors are in high tax brackets, so a lot of it's in muni bonds and muni high yield. But we do invest in private credit, and there is a lot of hype around there, and you want to make sure, if you're investing, that you're investing with the right firm in the right places, because there could be some problems going forward in that area. As with any investment, you just want to make sure that you're with a high quality firm, and that, because there can be such a divergence in returns between the top and bottom quartile funds in that type of space.
RaeAnn, your family office clients, what is their appetite for alternative investments?
It varies, right? Every investor is different, but our typical allocation would include, between 20 and 25% in alternatives. Nice. And that can be a small amount in hedge funds, some credit-oriented strategies, or diversified multi-strat funds that give us different types of exposures than we can get in the traditional markets, and then rounding that out with private equity, private credit, private real estate, things like that. I mean, historically, you can get a 3 to 5% premium over traditional equity returns in private equity, and we have seen that it's additive to returns over time.
Are you going to Vanderbilt, Tennessee? I mean, RaeAnn,
I wish I was. If ever there was a year, this is the year, right? And you have to enjoy it while it lasts. So it's been a fun season, that's for sure.
RaeAnn, thank you so much. Don't be a stranger. Love to have you back. RaeAnn Mitrione with us at Callan Family Office. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A short visit right now with Anurag Rana, which should be a long visit. He is definitive on cloud and definitive on what these companies are doing. Anurag, over the weekend, the consensus view was Google Gemini 3 was a home run over the Fenway Wall, over the Turnpike, over the Cascade Flagon. How big a home run for Google was Gemini 3?
Now, I think it's a big deal. I mean, you could see the stock reacting today. And one of the things we talk about in a note today is that Apple is actually going to, use one of their models for Siri upcoming release. I think that's a very good deal for Apple. They don't even have to pay as much. I mean, they're going to pay probably around $1 billion a year for it. And, that's so, I mean, it is very clear now that it's not going to be OpenAI taking everything. It is going to be spread across multiple models. And I think that's, the big takeaway for all of us.
Is this the Apple AI play then, Anurag? Is it to partner up with existing players and say, that's it, that's our play?
Yeah, and Paul, we just, one of the notes that we published today basically shows that Apple's capital expenditures as a percentage of sale is merely at 3% compared to Microsoft at 40%. And what Apple is saying is, you guys fight it out and tell me who has the best model. I'm going to just use it in the end, and I'll pay you, if you're lucky.
All right, so what's the next data point you're looking for on this AI play? We had the really good numbers out of NVIDIA. What's the next, when you talk to your institutional investor clients, what's the next kind of data point milepost for you guys?
I think one of the things we have to do is look at the application of AI models across all verticals, different sectors. What are they doing? What is the final game for banks, for hospitals? Because everybody understands the AI infrastructure play and what's happening over there. But what is the use case? And that's where I think the digestion is going to take some time, whether it's all of 26 or maybe 26 and 27.
So what are you watching for into the end of the year, into the first weeks of January, Anurag, Rana, within this AI, like where is the revenue going to come from? Is that a study you're having with your team?
Yeah, so the revenue is going to come from enterprise applications. So big, you could say Fortune 2000 companies, when they're going to take their applications, their core business, and add more AI capabilities within that. But the thing is, unlike just going out and getting a consumer app, there is usually going to be a long tail or a while when enterprises add that particular capability. Now, I think throughout the year, we're going to see moderate pickup in those applications. The big question right now is what happens to the AI infrastructure build? And one of the things we have been talking about is, when it comes to the hyperscale cloud providers, whether that's Amazon, Microsoft, or Google, we're really not that concerned about them overbuilding. But because even if, let's say, they overbuild and they don't have to do anything for the next 1 or 2 years, their core business will take care of that build of infrastructure. That's not true for somebody like an OpenAI.
Need a longer visit. Anurag, Rana, thank you so much. With Bloomberg Intelligence, just world-class technology analysis.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.